The release valve is the balance sheet of the Federal Reserve. And I think this is probably the biggest tell, even more so than these buybacks and some sort of backroom deal. They'll do it. They'll get there eventually. I think maybe they'll announce it at Jackson Hole in a few weeks in Wyoming. But at the end of the day, Besson has told us where we're going with this. It's unlimited Fed money printing to absorb the potential sales of treasuries and other U.S. assets. And that is going to expand the balance sheet. That is the big story. I think the buybacks is just sort of an indication that we know where their pain threshold is.
Forget everything you thought you knew about last week's Bitcoin rally. That was a tremor. We are currently standing directly on the fault line of a monetary earthquake. When the largest sovereign bond market on the planet starts cracking under its own weight, the math stops working and the money printers are forced to violently spin back to life. We are watching the real-time demolition of financial gravity, and the resulting wave of fiat liquidity is going to make Bitcoin's recent explosive price action look like a warm-up drill. Arthur Hayes sees the exact blueprint forming, and it points directly to the Federal Reserve's balance sheet as the ultimate, unavoidable release valve. This isn't just a speculative theory about interest rate cuts, this is about forced systemic intervention. With key figures telegraphing the endgame and backroom deals likely brewing ahead of Jackson Hole, the Fed is being backed into a corner where absorbing a catastrophic sell-off of US Treasuries will require unlimited, unadulterated money printing. This impending liquidity tsunami triggers a massive systemic repricing. Hayes connects this aggressive debt management strategy straight to the exact financial dysfunction that birthed Bitcoin from the ashes of 2008. The system is trapped. Policymakers must either let the bond market collapse and take the global economy with it, or flip the switch, expand the balance sheet, and ignite the most aggressive repricing of scarce, hard assets we've ever witnessed. In today's breakdown, we are tearing into Hayes' Spitfire analysis from the impending tidal wave of Fed money printing and the stealth bailout of the Treasury market, to why he's completely disregarding traditional chart technicals to bet heavily on Ethereum's massive asymmetric upside. If you want the unvarnished truth on where this macro setup is heading, hit that like button, drop your thoughts in the comments, and ring the notification bell so you never miss an alert. Thanks, and enjoy the video.
For somebody who's just got into Bitcoin in the last year or two, and they're still trying to understand macro, simply put, what does debt buybacks mean for them?
It means more liquidity, more units of fiat chasing a finite amount of goods, Bitcoin being one of those goods, number go up. This is the road to 2008, the road to what created Bitcoin. And so that is what you're here for. This is the exact moment why you want to own Bitcoin, is when everyone realizes, oh, this US government bond is not worth anything. I can't buy anything real with it. I can't even trade this market because it's such a manipulated market. I need a real store of value. I need something that really is going to respond positively to a lot more dollars chasing scarce goods. That's Bitcoin. That was the story in 2009 when it was created. That's been the story ever since. Obviously, it ebbs and flows with the liquidity cycle. But if you want to talk about an acute moment where the world says the emperor has no clothes, the largest sovereign debt market in the world, if people are actually worried that yield curve control is coming, the price of Bitcoin is going to be in the hundreds of thousands very quickly.
Were you watching when you were in the markets in 2008, the big financial crisis? Were they buying back bonds? Was it a similar setup the year before, 2 years before? How close were they doing the same stuff up until the crash?
So obviously the crash, the first thing that they did was they bailed out Bear Stearns. Not bailed out, but they allowed Jamie Dimon to buy Bear Stearns for $2 to give a bunch of loans. It was a sweetheart deal for JP Morgan. That was the first tell. Then they thought that they liked free markets, and Lehman failed. They figured out they don't like free markets. And then you saw all the major bank CEOs get on the shitty Amtrak train and like these guys ever take the train. No, they were taking the public's money, so they had to like they actually gave a. So they got on the train, they went down to Washington, got on their knees, sucked some, and got $700 billion. Right? And then people were like, what the how is it that the Goldman banker gets his bonus and my house gets foreclosed on because I didn't pay? They didn't pay either. Why did Goldman get bailed out and the AIG get bailed out and why all these guys get paid and I lost my house? That's Bitcoin. That is the start of Bitcoin was this. I believe, like, obviously I don't know Satoshi, so who knows? But if you read the rhetoric in the white paper and the time in which it was released, I think that the release of Bitcoin, one of the proximate causes was that the U.S. defaulted on its obligation to maintain a sound currency in the bailout in the aftermath of the 2008 crisis.
So, what other liquidity strings do they have in their arsenal, their toolbox to pull? And what comes next, 2026, 2027, beyond?
So obviously the big thing that Besson teased was this FEMA repo. So if you think about it, there's all these foreign governments around the world, Japan being the most prescient right now, not prescient, but the one we care about. And they own something like, I don't know, $1 trillion worth of treasuries. They need a stronger currency. They need capital back home in Japan to help them remilitarize, to, hand out goodies to their population who's suffering from inflation. And they've indicated that, hey, we're going to change the policy where we're going to encourage the corporate sector, the, private sector, and government and quasi-government entities to sell foreign assets, which means U.S. stocks and bonds, and sell those dollars, buy yen, bring the yen back home in Japan, and let's build a better Japan. You could say the same thing about the EU and Germany and a lot of other places around. They need to spend money, whether it's on the military or different social programs, and all the assets that they own are sitting in U.S. financial markets in aggregate. And so they have to sell them. But the U.S. can't have the largest buyers turn to largest sellers. That would destroy the markets. The only reason why the US outperformed so much was all these countries were buying this stuff for the past, 20, 30 years. And if that flow reverses, then it's, watch out below for the treasury market, for the stock market. And that can't happen. So that's why they rolled out this, not a threat, but hey guys, we need to up the counterparty limit to, no limit on this FEMA repo facility. So if you want to sell your treasury debt security, don't do that. Come to the Fed. The Fed will print some money, give you the dollars, and then we keep rolling this loan. You take those dollars, you go in the FX markets, you sell the dollar, you buy your own currency. Now, the US government wants the US dollar weaker, and so does the rest of the world. This is a way to do it where it doesn't blow back on the US financial markets. The release valve is the balance sheet of the Federal Reserve. And I think this is probably the biggest tell, even more so than these buybacks. But right now, they can't do it yet. It requires Warsh, John Williams and Jefferson of the Fed to agree to do it and some sort of backroom deal. They'll do it. They'll get there eventually. I think maybe they'll announce it at Jackson Hole in a few weeks in Wyoming. But at the end of the day, Besson has told us where we're going with this. It's unlimited Fed money printing to absorb the potential sales of treasuries and other U.S. assets. And that is going to expand the balance sheet. That is the big story, I think. The buybacks is just sort of an indication that we know where their pain threshold is. It's around 5% on the 10-year. And if it looks like that is going to be breached anytime soon, they're going to keep going down this road until we get to explicit yield curve control.
The terrifying brilliance of Hayes's analysis is that the Fed hasn't even officially crossed the Rubicon yet. But the architectural rigging for unlimited printing is already fully exposed. Treasury buybacks are just a band-aid. When yields hit the ultimate pain threshold, the Fed's balance sheet is the only shock absorber left. The moment they officially expand that balance sheet to swallow U.S. debt, it injects weaponized liquidity straight into the veins of the market, positioning Bitcoin for a violent, parabolic breakout that absolutely dwarfs last week's momentum. But spotting this macro shift means throwing out the traditional retail playbook. Hayes makes it brutally clear, you cannot trade this historic liquidity event by staring at lagging technical indicators or drawing lines on a chart. Instead, he's tracking market psychology, global capital flows, and hunting for deeply asymmetric, under-owned assets. Which brings us exactly to why he believes Ethereum is a coiled spring waiting to front-run the broader crypto market.
Honestly, I don't really look at TA that much. There's this guy I follow named Milton Berg, and he does TA on equity markets. And right now, Bitcoin is a follower of equity markets, US equity markets. And so if the US equity story is going to break down because everybody holds the same things on the margin, when people get margin call, they sell what they can, right? Bitcoin's a liquid asset, you sell it. And so I monitor that in terms of when this guy's buying, when this guy's selling. Do I have a particular TA setup on a Bitcoin? No, I mean, I think, 60,000 is a big level. Obviously, 100,000 is a big level. The previous all-time high, 125 or 26,000, that's a big level. But like in between, I'm not really in the weeds trying to trade this stuff. It's not really my style.
Couldn't we say, and I don't want to put words in your mouth, correct me if I'm wrong, couldn't we say the 200-week moving average for any asset with product market fit, one of the most important technical indicators to look at?
Maybe. I don't know. I could tell you that. I never look at it. So
Okay.
I
I
don't
thought
trade on technicals. I'm more of a
vibes.
big picture story vibes. I love vibes because at the end of the day, we all have to tell ourselves an internal story about why we're buying and why we're selling. Now, hopefully, the liquidity story matches up with a vibe story or a trending vibe story because you don't want to invest when the vibe is super strong. You want to invest when it's like just bubbling up from the surface. And then I want to see an asset that's unloved. This is why I love Ethereum. And I think that it's going to outperform in this sort of liquidity rally of crypto versus any other major cap crypto. I mean, yeah, the Robinhood RWA narrative is a good one. I mean, obviously, the actual amount of gas fees going to the base layer is de minimis, but that's not the point. It's all about narrative. And it has not eclipsed its 2021 all-time high of 5,000, whereas pretty much every other major mega cap crypto has in this past cycle. So it's behind, and that's why I like it. And again, it's not going to zero immediately. Like I don't think I'm going to wake up one morning, and of course this could happen, that ETH is like 75% off because something happened. The thing has been running since 2015 versus some of these other blockchains that have been around for like, 3 years. So you have a much larger risk of that. So I feel comfortable in our portfolio of strapping on a lot more notional on a long ETH trade than I would on any other crypto, just because of the Lindy effect and how long Ethereum has existed. Well, I think at the end of the day, who has the largest developer community? It's Ethereum. I don't care about all these other bells and whistles. Tell me a DeFi primitive that was created first on any other network besides Ethereum. There's been zero. So this is where the creative energy is. This is where the developer talent is. Yes, people can take some of the ideas and run with them and make them more sexy on Solana or some other platforms. And obviously people have done very, very well in that. But that was last year or 2 years ago. What have you done for me lately, Solana? Not anything. Like Ethereum hasn't done anything for me in the past, call it 4 or 5 years. And that's why I think it's a prime candidate to outperform.
Bitcoin hits 200,000 in the next 5 years, let's say. Maybe it's 2, maybe it's 5, whatever. Where's that put Ethereum?
I don't know. I don't know what the ratio is now, like 20,000, 25,000. I don't know, maybe.
This entire macro framework boils down to one undisputed reality. Liquidity is the apex predator of financial markets. It dictates the direction, the velocity, and the magnitude of every major crypto cycle. The US government has stacked up a debt burden so astronomically high that servicing it organically is mathematically impossible. When the pain threshold breaks, the central bank has to choose between a catastrophic tightening of financial conditions or stealth quantitative easing. Make no mistake, they will choose the printing press. That is precisely why the 2008 parallel isn't just historical trivia, it is the fundamental investment thesis for Bitcoin today. Satoshi Nakamoto engineered a perfectly scarce asset to counter the exact scenario we are watching unfold, a systemic breaking point where policymakers have zero choice but to devalue the currency to bail out the sovereign bond market. If last week's rally felt explosive, it was merely a preview of the price action we will see when the realization of unlimited fiat debasement fully hits the institutional panic button, and that's where the brutal logic of Hayes's Ethereum rotation comes into play. It has nothing to do with Ethereum suddenly winning a tech war or boasting the absolute cheapest gas fees. It is purely about network depth, market psychology, and severe underperformance. While the rest of the market has blindly chased all-time highs, Ethereum has lagged, making it the most unloved, under-owned mega-cap asset in the space. In a nuclear liquidity event, the assets with the most compressed energy and asymmetry always snap back the hardest. The ultimate takeaway is this: stop obsessing over the hourly candles and start watching the systemic pressure gauges. Watch the Treasury auctions, watch the Fed's balance sheet, and track exactly where the capital flows when the system inevitably cracks. The money printer is gearing up, and the next wave will not wait for you to get in position. If this macro breakdown gave you an edge, smash that like button, subscribe to the channel, and share this video with anyone who needs to wake up to what's coming. Thanks for watching, and I'll see you in the next one.